Good morning, everyone, and welcome to the European Crossover webinar. And we have seen quite the pullback here in equities markets, pretty much across the board. Not as strongly as in the Russell, and that was the one that was kind of holding up the market. We talked about it yesterday. We haven't talked about it here on the show. Also, how we're kind of somewhat overstretched and how the market has gotten somewhat, I wouldn't say unreasonable, but kind of overdone with the moves that we had seen up here. When one of the things that we had talked about, and I know I mentioned in the chat room, I think I mentioned also here, was if you look here, right here, we were just knocking on the door at the 200-day moving average. And one of the things I did mention in the chat room, I know for sure, was it later on the U.S. session, we had rallied 36% off the lows. I mean, we had rallied 220 handles just since Thursday. So this has been already a pretty phenomenal run back. And we just want, like I said, taking things into consideration. I went in depth or went a little bit at length talking about, a little anecdotal point or whatever, which was, remember I mentioned about lows yesterday and how that it started out at, I think it was 122. I'm not a stock person, but I mean 122 before the virus, and then fell correspondingly right after, all the way down to 61, and then turned around and rallied all the way back up to 122 2 days ago, and thinking that the moves that we had seen were so overdone. Yes, the Fed had stepped in, but also part of the reason is that we extended those gains was because of these stupid vaccine stories that anytime there would be just a whiff of anything, the markets would just turn around and run up like crazy. And case in point, that company Moderna, they actually gave up all their gains since the virus jump. All of them are all gone. So that's what I'm saying, is it was just ridiculous. The markets were so interested in latching onto these stories that it just didn't even matter. So we've seen a lot of that, and still seeing some other companies still coming in saying, so I don't know what company it was. I know they announced it over the squawk this morning. Oh, they're in the second phase of human trials. Oh, I don't give a doggone. It's all a bunch of BS for the most part. And BS in the sense that none of that stuff is going to come anytime soon. So for the markets to be reacting like this was just plain nuts, and you're starting to see that now. One of the things that we'd mentioned yesterday also is, we weren't looking for the market to collapse or anything like that. If you can see here, here's the low that we saw in May. This isn't anywhere even close. I mean, I'm talking about, middle of May. And so just a pullback just to the 28.94 would be a 38%. We haven't even made it to there yet, and that's what I'm saying. That's just a reasonable pullback. I was doing a little bit of technical work, and that actually confluences here with this level of 28.90. You can see this coming across. Pretty good level right there, 28.90. Matter of fact, I'm going to highlight that. So look at this 28.90, okay? And then you got 38% back, which is 28.94, 38% back from the lows that we saw, 27.60. Remember, it wasn't even that long ago. Like I said, freaking Thursday, I think it was last week. And I said we had rallied 220 handles. And so the 38% back will put us at 28.94. You can see here we've got a good level there at 28.90. Look, we bump our heads up against here. Look at that. This is the second time we bumped our heads up against this 28.90. This it might have been like 28.85 or something like that. But look, 28.90. So boom here. We bump our heads up again. We take another dip and we push right through it. And then we come down here and basically test this line. We rally back up here. We test it again. We rally up here. We come back and test again. We rally up here, and then when we break, we see some fall through. So 28.90 is pretty key, okay? Then along with 28.90, you've got 38% back at 28.94 from those lows we saw on Thursday, okay? And then also 28.90 is 127% extension of this run. So it kind of gives you a little bit of a target that they may want to go for. I mentioned that yesterday, or I did mention it. We were talking about that length in the chat room while I was thinking that it was overdone. We should come back, see right there. So the other thing that had me a little bit cautious was because as we go into a 3-day weekend, lots of times you'll see a rally, in equity markets. So I was thinking that was kind of keeping it a pause. And even late in the day, remember I mentioned in the chat room how we were following that Russell. The Russell was pushing up against this key level, 1351. I was saying, boy, if we get a 2-hour close above 1351, that really, keeps the pressure on, opens the door for us to potentially still go higher. We closed right there, and then we started to slide back, and the slide hasn't been huge, but we've slid nonetheless. So that's where we're sitting right here on the Russell. Looking here at the NASDAQ, same situation here in the NASDAQ. You can see here's that fall all the way down in here. And we come up, we rally back, we touch this for, basically a confirmation here. We hold it, and that opened the door for us to move much higher. So if you're looking at 38% back, we've already got past the 38% back at 95.27, and then the 127% extension of the most recent high and low right here to here. Would put us right there at 92.07. But like I said, with the NASDAQ, it's been really pushing levels, because obviously we saw the new highs in Facebook. We've seen Amazon still continue to outperform. Apple also came up much higher. Pusha says he can't see the charts. Hold on. Oh, okay. I'm sorry now. I had the wrong one highlighted. Okay. Thank you very much for that, Naz. Pooja, appreciate that. So yeah, let me go back and I'll touch on these again. Yeah, it was focusing on the wrong thing. It was focusing on the book map for the Dow and the Russell. And the reason those things are key, because as you know, during the day, like a scalp, and I'll be looking at the different markets. And so even though I scalp, I kind of look at how they all play off against each other. And thanks again, Pooja, I appreciate that. And so that's what I'll be doing. I'll look and see which one's breaking or whatever, and it kind of allows me to come in at better levels, whatever. Anyway, you know what I'm talking about. Anyway, let me go back and I'll touch on this. So thank you very much for pointing that out. So getting back here, I'll go back here to the SPOOs. So what I was mentioning here in the SPOOs is we had talked about that, and we saw it came down now. What I was mentioning here is we had rallied 220 handles here from just Thursday, and that's what I was pointing in the chat room yesterday, early in the U.S. session. I thought it was freaking nuts. I mean, look here, we were just like a spit away from the 200 bar moving average. Are you effing kidding me? So that's what I'm saying. We had this rally, and I thought it was plain nuts, the way we had extended. And I thought, okay, I'm not looking for this thing to collapse or anything, but just a reasonable pullback. And one of the things I had mentioned for the last couple of days was this 28.94, 38% back. So once again, if we look in here, here's the pullback we saw all the way down to Thursday. I remember mentioning, hey, there's good 2H support at 27.74, and I actually ended up buying there, or I said 27.72. I remember, and it kept falling. And I remember picking up a couple of times, and finally, I'm always too early, but finally we put it in a low, and then we started moving higher, and we broke higher, and we came back, and I remember putting these notes to myself, hell, that was a telltale, because you can see here we're held. So anyway, fast forward to where we've been, I thought we had really gone overdone. So what I'm looking at here is, if you look here, you see here this, and I'm glad that Pooja pointed that out. So here's the 28.90 I was telling you about. Look at the importance here. So you can see here, I ended up highlighting here. So here's the first one at 28.90. Okay, we pull back. Then we come back again. We try it again here. We come back again. We finally break above 28.90. Okay, this is the significance of 28.90, and then we rally up in here, kind of come back towards there. We rally back. We fall back to 28.90. Come back. Fall back again. Once we break through 28.90, third time's a charm, we really saw some follow through. Okay, so that's the significance you can see of 28.90. You see how that's really an important area here. You can see previously, look on here, you see a lot of good volume touches right here. So if you're looking for a target, and that's what I was talking about yesterday, specifically, I said, hey, look, I'm not looking for this thing to collapse, but down to about 28.90, 28.94, and 28.94 is at 38%. You can see here. Now, to look for a confluence, you go, okay, well, yeah, that's pretty key. 2890 looks pretty good. I mean, you look here on the way down here. That's kind of like a lot of volume here, which I like to call a battlefield. A lot of fighting here, and then one-way breaks. So we finally fell through. So on the rebound, where do we go to? 2890. Maybe we came up to like 2887, 2888. What's the difference? But anyway, we came back down. We rallied back up. We come up a little bit short. We fall back down, we rally back up to 2890, we pair back just a little bit, and we finally bust through. And then you can see back and forth, support, support, and then we break through. We see third time's a charm on the way down. So I'm trying to just stress the significance of this 2890 and where the market can go to. Now, 2894 is at 38% back from where we saw those lows just on Thursday, which I'm saying is, I thought it was crazy. We'd rallied already 220 handles, and we're literally a spit away from the 200-day moving average. So 28.94 there's at 38%. And then for some extra confluence, use this high, this low, this high, and wham, bam, thank you, ma'am, right there. The 127% extension. Confluence is right here with the 28.90 level, which confluences with the 38% extension back. So that'll give you kind of like a target. And I mean, like I said, we're not asking for the thing to come apart or come unglued. Look how far this thing, you see here? Look at that. I'm not looking for anything like that, and that's a March low. All we're saying is just a plain old little pullback to about the 38%. So essentially, we're seeing the same thing here with the NASDAQ, although we have already come down here to 38%. And one of the things I was mentioning before, fortunately, Pooja had mentioned, hey, you're on the wrong chart, or wrong screen, is that we finally saw NASDAQ kind of pull back. Now, we've seen NASDAQ kind of push hard, but part of those reasons were we saw the new all-time highs in Facebook. Once again, I mentioned earlier, I'm not a stock analyst. It's just that I keep track of some of these other stocks because I'm looking at these other markets, trying to see, kind of give me an idea of, okay, where I can see some additional weakness to get some follow-through on, let's say, on the SPOOs, which I mainly trade. But once again, we saw the extra push here in the NASDAQ because of the highs we're seeing in Facebook. Amazon also pushing much higher. Apple was pushing much higher yesterday. But finally, we started to see that thing give in. And one of the things I'd mentioned, I was mentioning here in the chat room yesterday, not only are we starting to see these vaccine stories really starting to lose some of their luster, but also remember about the Chinese delisting and the concerns about that. And then I mentioned about, someone on Twitter, that they're always tweeting their book. You can always tell because obviously they were long equities and they were like trying to play down the whole thing. I'm thinking, no, that's a big deal that the whole delisting, not because, and I think he was saying, oh, does it mean it's really going to happen or something like that? I don't remember exactly. But my point is, you have to factor in the risk. If we were all the way, one thing I mentioned in the chat room, I said, one of the things I always look at is relative value. That's my own thing. And the reason is I'll look at the same time, even though I really only trade the SPOOs, I'll look at the NASDAQ, I'll look at the Russell, I'll look at the Dow. And the only thing is I'm trying to look at, relatively speaking, where are we? So once again, like I said, to go back, if we were way down here, maybe that Chinese story doesn't mean a hill of beans. But look where we are. We're up in the freaking stratosphere. So I'm just saying this. My point was, someone had asked us on Twitter, they were saying, not to me directly, but they said, do you really think that would really happen if it's really believable? And my thought was, that's not the question. The question is, you have to factor in the risk. We're up here in the stratosphere. The old saying goes, when you're trying to buy stocks or whatever, you won't hurt yourself too bad if you fall out of a one-story window, but you'll sure as heck hurt yourself if you fall out of here, out of the 10th story. You see what I'm saying? That was my thought was, once again, relatively speaking, do you have to factor in the risk? And I thought, yeah, you have to factor in the risk. So finally we saw, even though Facebook making new highs, Amazon making new highs, Apple still pushing up higher, you still had to factor in that risk. And finally, we saw a bit of a culmination yesterday. Maybe not a true culmination, but we saw this market finally pull back. I had mentioned here, here was the Russell. It was still holding the market up pretty well because it was pressing up against this 1351. So anyway, that's my take on that stuff. Just wanted to touch base on it. Obviously, we're pushing lower. One of the thoughts or concerns I wasn't too as aggressive is because quite often you'll see U.S. equity markets rally ahead of a 3-day weekend, and we have Memorial Day, so we do have a 3-day weekend, but we still finally broke lower and attach these lows. But if you're looking for an eventual area, maybe we'll come back here. We've already seen the market challenge it this morning, 29.21. You can see here we got up here, we rolled right back down. Maybe we can come up to, if you're looking for an area, maybe right there, which would be 29.30. I don't know if it make it all the way back, but maybe it will, or maybe like 29.25. But if you're looking for an area for this market to eventually go to, I would say this 28.90 right in here. Anyway, enough of that. We'll take a look at the calendar, which is pretty sparse. So we did see some UK retail sales data. They're looking for minus 16%, came in at minus 18%. And we don't have anything else till we get into the US session. Mexico data, and that's at 6 a.m., which is 7 a.m. Eastern. And then at 8:30 Eastern, we do get Canadian retail sales. And pretty much that's it. So we don't have anything. And housing prices at 8:30 Eastern. That's in Canadian data. So let's just go on and move into this to the news now. One of the things, the reason I went on to that little spiel was not to bang the table on that stuff, is because even though I'll trade the technicals, and quite often when I deviate from my technicals, I always get whacked every time. Talked about that a couple of days ago when I clearly said on the webinar, okay, look at the 30-minute EMAs. They're in buy mode now, and what the heck do I do when we come in the U.S. Open? I shorted it, and then you remember we had that run up all the way up to, got up to like 29.76 or something, and we came back down. We finally broke, and that was, once again, it was 2 days ago. The thing that ticked me off is that, you know, I pointed out that 30-minute EMAs were in buy mode. You can see they're clearly in sell mode now. And what the heck did I do? I went and, you know, like an idiot, turn around. I think this was it right here. You see here, and I said, okay, we've now turned into a buy mode. And what the heck did I do? As soon as they opened up, I go and short it, and it was in buy mode, you know, the whole doggone day. I came out okay on that, but certainly put myself under a lot of undue pressure. But anyway, getting back, let's go and hit the news real quick. But anyway, I was trying to say is I'd like to, one of the reasons we'll cover the news and we keep it pretty light is I like to put a little bit of a, I want to say flavor, but it sets a tone for the day. And then at least the way I look at it, I try and then factor in, or not factor in, but I focus on my technicals, but I use the news to kind of set the tone, or what I was given the whole spiel about the equities and the overall take kind of sets a tone, whether you believe it or, I mean, whether you agree with it or not. And then you look at the technical. So if you're really bearish, you go, okay, well then look, then we're looking for probably 28.90. Maybe I can go in and fade on any rallies or whatever. Kind of gives you some perspective. So that's a deal there. But anyway, let's go on with the news. Dollar edges up on rising U.S. China tensions. The dollar gained against major peers on Friday as worries about rising diplomatic tensions between the U.S. and China supported safe haven demand for the greenback. I did mention this in the chat room early in the U.S. session when they're saying, oh, the euro's going, and I'm like, and then they go, wonder why the euro's falling back. I'm like, I think that people are starting to move into the dollar because they're expecting an equity pullback. Although we hadn't seen it, we actually saw it as the day went further on as far as the equity pullback, and now we see the dollar, you know, gain from where those early U.S. session levels were yesterday. Sino-U.S. trade relations have soured over a broad range of issues, including China's treatment of the former British colony of the Hong Kong and its response to coronavirus pandemic, which is causing risk aversion to spread. The fresh geopolitical strains also boosted safe haven yen, but sent the yuan to a 1.5 month low and rattled both Aussie and New Zealand dollars. There have been problems between the U.S., China, and quite a while now, said Yukio Ishisuki. Some very short-term players are changing positions from one day to the next, which makes it difficult to see the trend, but overall the dollar looks to be supported. While the new frictions added some pressure to the yuan, the Chinese currency also found some support after policymakers in Beijing unveiled new stimulus measures as widely expected. The dollar rose to 109.25 per euro, following a 0.3 increase in the previous session. The dollar bought 97.15 Swissies, gaining more than biggest gain in more than 2 weeks on Thursday, and the sterling held steady at 22.16 before data later on Friday expected to show a plunge in British retail sales. We saw those are a bit weaker. China is set to impose new national security legislation on Hong Kong after last year's pro-democracy unrest, a Chinese official has said on Thursday. And Trump has also warned that Washington would react very strongly to the legislation. There's a risk that Hong Kong could lose some of its favorable U.S. trading terms that have helped it maintain its position as a global financial center. The Hong Kong was a little changed on Friday near the top end of its narrow band. And Washington and Beijing are also on loggerheads over Chinese companies' access to advanced technology, criticism of Beijing's response after the novel coronavirus emerged in the last year. The tension has stirred some memories of last year's drawn-out trade war between the superpowers. Chinese Premier Li Jinping pledged higher infrastructure spending. China did not issue a growth target for 2020. Aussie fell 0.5% across the Tasman Sea. New Zealand, just hitting some of these quick that aren't that much news. New Zealand's considered distributing cash directly to households to help the economy recovered from the coronavirus pandemic. The country's finance minister said on Friday the idea of direct cash transfers to households, sometimes called helicopter money, is drawing attention as the pandemic inflicts the worst blow to the global economy since the Great Depression. One thing I thought I would look at, you kind of went on a spiel talking about these equities, but I thought this was rather interesting. Let me go on and it's not something I could put in a story because the graphics don't play out very well, but I was going to cover it since we have time. It's a Friday. Let me go over this. So a crisis has blunted the euro's global profile. The coronavirus crisis may have dealt a lethal blow to the idea that the euro could one day replace the dollar as the world's preferred currency by exposing eurozone frailties and cementing the U.S. Fed's role as a global lender of last resort. You know, unless you've traded currencies for a while, you probably won't remember back in 2014, man, that they were really pushing for the euro to take over the dollar. And in the Asian session, you would see that euro pop up, like it would pop up like 60, 70 pips. I mean, God, those were the days. And what would happen is China would come in and just buy the euro in the Asian session. You'd see it push up. And the thought was that the euro could take over as the reserve currency, and China was doing its best. Eventually, they got their ears pinned back pretty doggone good on doing that. I think at the time the euro was trading around the mid to upper 130s at the time, if I remember correctly. But they would come in day after day in the Asian session. They'd push this euro up. You'd see it go up. Routinely, you'd see it go up anywhere 60, 85 pips in the Asian session. But anyway, so that's the whole backdrop on that. But anyway, these months have highlighted and possibly entrenched the dollar's dominance of global commerce, investment, borrowing, and other central bank reserves, savings, not least because of the differing U.S. and European responsibilities to the crisis. This week's proposals for a European Union recovery fund financed by jointly issued debt may burnish the euro's international role if it leads to the more cohesion within the bloc. But economists say that even the proposal makes it past a late May EU meeting, squabbling whether the budget spending or the issuance of corona bonds to aid poorer states has reignited fears that the euro could even break up. The crisis has again demonstrated that the euro may not be forever, said Joachim Fels, global economic advisor at PIMCO, the biggest bond manager. The dollar reigns even more supreme as the world's reserve currency. Now it's showing the euro in the coronavirus crisis, pointing out here. Panic grips the market. U.S. Fed imposes the repo limits down here. Fed second emergency rate cut. So it's showing here just the different ways that this was playing out during this. Then it goes on to say, already in the recent years, the euro's share in global finance has shrunk. The International Monetary Fund data shows its weight is allocated central bank reserves at around 20%, down from nearly 26% in 2010. Although negative European central bank interest rates are partly to blame, the dollar, meanwhile, has a 61% share. An ECB index of the Eurozone's international lows tumbled from over 27% in the early 2000s to below 22% in 2017. So you can see that continues to decrease. The euro has steadily lost ground in forex trading. Wow, well, we know that. It's just not, man, I used to just trade the euro. I mean, you could just day trade the euro. It used to be just a phenomenal thing. If you can remember back then, 2014, to maybe 15, maybe just a little bit later. I think that's when things really started deading off. The ATR, the daily ATR was right around 130 pips. 130 pips every day, so you could really make money just day trading euros. Anyway, the euro steadily lost ground in forex trading and currency derivatives and lags the dollar in international borrowing. Latest SWIFT data shows it accounts for 31% of global payments versus over 40% in 2012. The dollar share has risen to 44% from 30%. So the dollar is the lion's share of the FX derivatives market. You can see here, and it's highlighted. So the green, light green, that's the dollar, okay? And then the euro, look how little the euro is. Holy smokes. Look at the Canadian dollar. Wow. No, it's not the Canadian dollar. That's actually the Japanese yen, so I apologize. There's the Canadian dollar right in here. And sterling is right here. So anyway, dollar rest. The world's dollar dependence was underscored during the March market panic when businesses dashed for the greenback liquidity to pay bills, redeem debt, or just increase their buffers. It was proof that access to the dollar is paramount in times of crisis, so central banks will anticipate that going forward, and they'll need to hold dollars, said Brad Stetzer, senior fellow at international economics at Council of Foreign Relations. I don't want to expend the whole thing on here. I could, but we'll go on and get to the analysis. But just want to touch on that. It's not something I can just post out in the story because these graphics don't transfer over. So let's get into the analysis. I probably would have read through the whole story, but I spent all that spiel on the equity. So let's move this out of the way. Let's hurry up and get into the analysis. But I thought that was an interesting story. Just trying to squawk. European equity funds have seen the largest outflows for the fourth week in a row, and U.S. equity funds for the fifth week in a row have seen equity outflows. I don't know how these equities ever made it all the way up there, but they're continuing to pull money out. So they were taking, the Pierce folks are really taking advantage of this run to get out of equities. Not only European, but in the U.S. and the U.S. shares have gone up like bananas. So that's what I'm saying. I think so. That being said, we may be able to get that further pullback. You see what I'm saying? I mean, I was mentioning at least to the 38%, but we can probably see some continued follow through next week. So once again, it was Bank of America stating that the fourth week in a row for European equity funds being people getting out, and also for the U.S., despite those silly moves that we saw over the last couple of days. Let's go and move into the euro. So the euro had another unsuccessful attempt at breaking 110. Going into Friday, may find stuck bulls. Support will be 913 with resistance at 990. So 913. That doesn't mean the 913 is going to be all out low. It just means that we'll probably see some pretty good battling there. Up here, 990. Let's move into cable. So the cable closed a bit lower on Thursday with the dollar applying pressure across the board. Support will be 21.93 with resistance at 22.73. 21.93. Lows are already 21.61. Holy smokes. I may have to go and revise that sucker. Let's go into the 2-hour chart. Let's do a fib. Okay, we'll go with that right there. You can see we're a little bit of a touch here, a little bit of touch there. 2160 would be the 61%. And let's see if we can get a little bit further confluence. Looking at this low here. Yeah, let's go with this low here, which would confluence with the 61%. Lots of times the 61% doesn't hold the cable that well. So factor in risk, and it's also a Friday, so you may have some stuck bulls like I talked about the euro. So we'll go with that right there, which is 2151. Actually, I had 2135 yesterday. I don't know why the heck I came up with this 2191. Anyway, so we'll move this to 2151. And resistance, you can see these touches coming across in here. You see that? 2210. Right here. We'll go with that high right there, which is going to be 2227. Still a pretty good drop. Let's go and move in now to the Aussie. Seeing the spruce come up a little bit here. Oh, this Aussie has been something else. So what the heck? Doggone it. Didn't save it. Okay, well, anyway, we saw a pair back as equities came off yesterday, and we're seeing some further follow through. So the resistance is going to be right there, 65.97, and that might even be a bit of a stretch to say the least. But we'll go with that, 65.97. Once again, we're seeing equities under pressure. So on the pullback, I do remember keeping, when I did the analysis for whatever reason, it did say, I remember I kept the support the same. So it's going to be still the same, 64.78 here in the Aussie. Let's go move into the Kiwi. What the heck? Doggone it. Closer look. So the Kiwi closed weaker on Thursday, accompanied with its cousin as risk on lost its flavor. Resistance will be 64.12 with support at 60.50. And I remember I kept the support the same. So 60.50. The difference is it's going to be 60.12. Must have been looking. I don't know what's going on here. Must be the doggone Aussie at the time. So resistance will be this closing bar, which is 61.43. What the heck? So it's 61.43. Remember, I kept the Aussie and Kiwis support the same. Let's now go and move into the dollar CAD. So the dollar CAD pushed higher on. I don't know what the hell's going on here. I really don't. Anyway, I remember when I did the analysis, I said the break in U.S. equities finally pushed I think it gave it the new sense of direction. And of course, we did push higher. Okay. So the resistance, I still kept it relatively low. I think I put it, it wasn't too high. We'll go right there, which is 40.47. I don't know what's going on with this stuff. It's not saving. Although I haven't rebooted my computer this week, and I know it's running really slow. And I guess it for the reason didn't save the notes on my and it's not for the reason it's not saving it on here. I know it's running pretty slow today. Matter of fact, I was going to close my Reuters feed. Doggone it. God, all these stupid alarms. And support was going to be right there at this open, right here, which is 38. I'll just call it right there. Actually, I think I went with the level, which I did, 39.23. That's right, I remember. I'm gonna really be ticked off if they didn't save it for the peso either. So the dollar peso broke through support, pushing down to 22.85. You can see that right there. Resistance will be 23.23 with support at 22.85. So now let's go move in now to the peso dollar yen. So the dollar yen remains in a tight range even with weakening in equity markets. Support will remain at 714 with resistance at 796. So there was no change here for the dollar yen here. We're just stuck in the middle. I've been saying spinning tires all week. Just spinning its tires in the mud for the most part. Let's move on to the dollar index. So the dollar index closed better on Thursday as U.S. equities came under pressure. Resistance will be 99.72 with support at 99.23. What's the high so far? 99.80. Well, we'll stick with the 99.72, but it could push a little bit higher. Once again, that's why I just think that means that's where we expect some volume to be traded. We'll stay with the 99.72 and support is 99.23. And let's go into the cross rates. Uh-oh. I think my mouse just died. Hold on a moment. Oh, God. Let me see if I can get some batteries. Hang on a moment. Yeah, just for a moment. Okay, fortunately I got some batteries last week or a couple of weeks ago, so hold on. Holy smokes, there's not one thing, it's another. Hold on. So we're back in business. So, and quick look here was a look at these drops here. Look at uh, Google here. Facebook had moved to new all-time highs, but look, and Amazon look. So we're under some good pressure. Let's go move into the cross rates. So we did see this Kiwi yen finally back off a little bit. So resistance is just going to be right there at that closing bar right there, which is 66.05. Support, once again, always looking for the confluence of touches, and we're really way overextended here. I'm looking right here. You see this bar right there in the close? That comes in and confluences, that would be a good area for them to move to. I think we can go lower, but at least for now, that's a good area for some support, which is going to be 65.13. Let's go to the euro yen. Okay, now this one has really taken a good stretch. Remember, this was already a real good run. So we're just going to go with just the technicals. 1704 for support. I should say the levels. And resistance, well, this thing has really gotten, look at this move it had. So I think we're pretty safe to say right there, this closed, this open, and that confluence is right here with this bar. So that would be the resistance. And that's going to be 1771. Think of it as that's your risk. And that's really being pretty generous at that point. Seen a pretty good little rally here, at least decent little rally here in Russell. Let's take a look here. This one's dead in the water. The euro's weakening, the Aussie's weakening a little bit, so this market is just really no changes, no changes. I remember we did the same thing yesterday, so no changes. No changes here in the euro. So let's go move into the euro kiwi. Probably the same thing. Yeah, exactly. They're taking turns. Each one's trying to be the weaker currency. Um, $80.42. Yeah, it's just going to be right there. This low, which confluence with that high, that would be resistance. 79.94. And support, we can look at a fib, see if we can get some confluence. The heck, where'd the lines go? This is ridiculous. Let's go right here with this low, which would be 78.02. And on to the RCN. I'll put that later. Same thing, this is peering back as Aussie weakens. So the high would just be right there at the close here, which is exactly where they open. And that's probably even being a little bit generous, but that'll be, think of it as that's the risk. Actually, we'll move to 2 hours and get a better feel for this. Right there. You see this coming across? That confluence is here right there. See that? That'll be the high. I mean, that's the resistance, 70.52. And support right there. Decent volume coming in. 69.86. And let's go over into the guppy. I'll just move right into the 2 hour. As we've rotated low and we've broken this support area here, this is where they'll look to go to for volume, which is 30.53. Just call it 30.55. Resistance, just go with the technicals right there, that level, 31.35. And starting node. We are above this level. Remember we talked about defending that. Remember how we got here, came back here and tested it, came off. Resistance is going to, I don't think we're going to get there. Let's go right here with a little bit of, see the touches coming across here. That's going to be resistance, which is actually where we went to, 87.21. So that'll be resistance. See how they go to those touches where the most volume is at? And that would make sense because you'd come down here, you defended it initially, you came rallied up, you tested it, defended it here, so that would open the door for us to move higher. That's what we're going to do. Support is going to be, we'll just go right here, same thing with the volume touches, 86.46. And that's going to cover it for FX and the European crossover webinar. Good luck, everyone. We'll see you in the chat room. And boy, the euro still continue to push lower in here. There's some support right there at 9. Oh, actually, it's 892. 892. See there? See these touches all? Look at that. That's pretty key. That'll probably be a pretty good area right there for 892. I guess we'll update this since that's a key technical area. Well, let's go with the 892 right there. But that's a pretty good area right there. You see that? And actually, the real volume comes in just a little bit a hair beneath that, which is right in there, which is 886. But we'll stick with just the technicals that we have, which is 892. Anyway, thanks for joining us here. Have a great weekend. See you in the chat room.